$1,000 into these two stocks can surpass your full-time job. I'm not a financial advisor, but Abercrombie and Fitch, ticker symbol ANF, just had Q3 earnings and reported over $1 billion in revenue, up about 10% year over year, and 15% growth in their Hollister brand. So it's not that you don't see a lot of people wearing Abercrombie and Fitch apparel. You see the Hollister logo maybe more often. Big growth there. And other retail stocks are doing well as well. Ulta Beauty doing awesome. Kohl's doing awesome. Victoria's Secret had good earnings as well. Victoria's Secret during COVID was down to about, 0 retail sales, right? And now it's up to 40%. So, e-commerce definitely helps these stores. Maybe they sell more in e-commerce than off, actually. But for a lot of these companies, when do you go to a retail store? You need something fast, or you think you do, right? You get that impulse, or you want to try it on. And, in the case of Victoria's Secret, you might not believe it, but women can discern, they're very smart creatures, 1/16 of an inch change in the size of a bra. So that's why some of these stores are still sticking around. People want to try stuff on. For Abercrombie and Fitch, Hollister, we can look at the same store sales versus e-commerce, but the earnings were solid. There's one company as well, if retail is not your thing to invest in, INSP is the ticker. It's a healthcare company, Inspire, and they do CPAP, sleep apnea solutions. Over 100 million in revenue, up like 7% year over year. And sleep apnea affects, tens of millions of people in the US alone. And you can wear a mask, that's the whole CPAP thing. But what they have is an injectable. So it's a little bit, less or more intrusive depending on how you look at it. But people are buying it, doctors are buying it and recommending it, whatever the case may be. The chart looks solid as well. And this is one that is not directly after earnings. This is built out of flag. So let's look at that. Let's talk about what a flag is. We're not really going to talk about it. We're just going to look at this particular one. And let's jump into it here.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
All right, so this is Abercrombie and Fitch. These are their peers. I'm sure you're familiar with American Eagle. Maybe not you, but Gap, Urban Outfitters had great earnings as well, and Lulu. So let's look at the actual chart for this, and just to get one more look. This is Inspire. They use these little pulse systems, neurostimulation, to help with sleep apnea. It's FDA approved. It's stimulating the tongue and airway muscles during sleep, preventing blockages. So it's approved by the FDA. This is why we have the FDA, for things like that sound a little fantastical or intrusive. But what's intrusive is not being able to breathe while you sleep. So let's look at these charts. Abercrombie and Fitch just had earnings, and the beat on earnings. And it's having a nice little pullback here, which is, it's fine. The market is doing great. The last 2 days weren't crazy, though, compared to the week before. So the Abercrombie and Fitch day must have been on the 27th, 28th, 30th, something like that, right? It was on the 25th, actually. It was a little before that. So it was on this big day. So we have to be a little careful, I guess, because at a time when the SPY drifted up, the percents don't really matter. But you can say, here's a comparison that might make sense. It went up 2% on the 25th, and it went up 1%, little 1.25%. After that, Abercrombie and Fitch, way more, right? 40%, and then it went up, way less than half of that. So the earnings definitely mattered. You can look at the earnings in detail. Well, look at the revenue, look at the profit, look at the guidance. That's pretty much all the detail is. But the point of it coming back is it's not really too much worry about the weakness of the company. It's more about now you can get a nice risk level off of. The second day is pretty awesome right now, 95. So if futures stay sideways on Sunday, and then on Monday maybe we get a gap up or just a hold here, that's perfect to risk here. If we do gap down, then you can risk that high volume close. It's a little bit wider of a risk, a few dollars, which means you need like, $30 of upside potential, but ideally it just holds here. So that's the play for Abercrombie and Fitch. And for Inspire Medical, this is a recent liquidity push. This was on November 24th. We actually definitely want to look at that. But the point is, it's kind of a little flag here, and it looks pretty sloppy on the 24-hour, the daily chart, whatever you want to call it. But once you sort of zoom in here, it starts to look pretty. So this is pretty clear breakout level 142. I'm not saying you definitely want to buy breakout levels, because sometimes they can reverse. I'll just give you a little example. ASTS, maybe you were trying to buy over this high or whatever. This is actually a terrible example because it did go. But the point is, sometimes you can have a little bit of a fake out. So, this is a terrible example. The point is, sometimes you may have experienced, if you're like me, you buy a breakout and then it doesn't break out, or it does and then it fakes you out. So what makes more sense is, instead of buying at that exact breakout level, if everyone's watching it, yes, there will be a lot of buying there. But instead, what you can do is look for a level that makes sense to you, aka that you're going to actually follow, and buy off of that. So maybe it's risking yesterday's, or this is not yesterday, this is actually Wednesday's high, depending on where we go. So throw in a stop that's right there at 138, or watch your phone, check it on your phone. And if it just moves away from there, then, so just to see what that looks like over here, this is Wednesday. So risk this level, risking $1 to make 10. And, is that reasonable to make 10? It's very reasonable. I mean, that's barely a move at all on a 5-year chart, but it's not really realistic to look at a 5-year chart. This is a little more interesting. $10 is from here to, it's like 4% or something like that. It's fine. So that's why a tight risk is really great. You're going to stop out a lot, maybe 70% of the time, which I know sounds like crushing, but hey, do you want to have small losses, or do you want to have a lot of wins? You can choose. So yeah, it had a nice gap fill here too. I'm not saying that gap fill always matters, especially with tiny stocks, but this is not a tiny stock. This is actually a profitable company. We can look at that exactly to verify that. But it came up over this level of price agreement prior to earnings, and it's holding. So that's a really important level, 130, kind of this rejection and then breakthrough there. So if it does pull back, that'll be another level for you. But those are the stocks. And I forget already what we were trying to do. We want to talk about INSP profitability. And then it would be great for Abercrombie and Fitch to talk about the revenue, the guidance, the sales in detail, aka did they increase? And they did. So that's really what we want. This isn't like a triple digit increase, blowout earnings or anything like that, blowout, profit, or a surprise as far as I know. But what is happening is 7% increase year over year in revenue. I think I might have misspoke earlier about which company increased by 7%, but anyway, and then that beat consensus estimates. And the profit, I just like to say profit instead of the earnings. Earnings is confusing in my opinion, to me. So profit also beat expectations. So that was a little bit of a surprise. And then guidance also beat. So yeah, outlook and guidance lifted just slightly. But when all three are lifted, you don't have to worry about one of them dragging down what could otherwise be a really positive story about this company. And I'm not saying to buy on a story, but this is about as disconnected from a story as you can get, right? I mean, it's a numerically grounded story. So if we want a story, another way to look at that is it's actually rather uninteresting as far as what we've unearthed about how the company's doing. They're buying the clothes. Like, I don't know how to get excited about this. Hollister does nothing for me, but I'm not, 12 or whatever. I don't know. Here's some other retail companies, though, that we want to look at ticker-wise. AEO and Gap. Let's start with those. So AEO definitely looks interesting on earnings, and the little pullback is fine. Gap, same deal. Urban Outfitters, same deal. Lulu has earnings coming up, but moving up in anticipation, and Kohl's moving up as well. So this isn't like a random ticker I just pulled off the shelf. The whole sector is moving up. Does that always mean that it's going to keep moving up? No, but that's why we have risk levels, here and here. So that's Abercrombie. And then as far as INSP, that looks like this. And as far as what they're up to, their profitability, we wanted to check on that. They had revenue up 10% every year. Gross margin, you don't like the word gross because that doesn't necessarily mean they're profitable, right? But maybe they are. Blah, 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 blah. Share repurchases. Earns real profit, generates cash. So somewhere we're going to need to see, I guess, earnings per share being positive. That's profit. I'm sorry to be so facetious and, just cynical about this, but it does sometimes feel, when you read through these, it's like adjusted non-GAAP earnings per share once removed. And it's like, you just want to ask them, are you profitable or not, right? And it seems like every indication is that this company is, so we're just going to have to say that. They were unprofitable, and now they're not, I guess. So this is another good measure, is cash flow. I guess if they didn't have this, they would be reinvesting it, buying a bunch of new, development equipment or something. So that's good. If there's no free cash flow, it's kind of ironic, I guess, because they would say, great, you're reinvesting everything in the business, but we're not trying to grow the business. We're basically vultures. We're just trying to make money for every little, 10% move. And then if it does move up 10%, that's great. Maybe it'll have a little pullback, and you sell half on that 10%, and then the rest you'll trail, right? That's the name of the game, just to have a little come to Jesus, refresh on why we do this. Well, if you do get an NVIDIA, right after earnings here or somewhere in here, right? Sure, sell 10% when you're 10% up, somewhere in here, right? And then you hold the rest, you just trail this moving average, or maybe, if that moving average is serving you well, you start to trail another one, and then suddenly you're up 30%, or if you're really patient, 50%, and you want to just trail a 100-day or something crazy like that. That's sort of the name of the game, just to zoom way, way out on what we're doing here. But profitable company, we know what they do, CPAP. We're not running the company. No one's going to claim that we actually know enough to work there, but we're not trying to work there. And then Abercrombie and Fitch, same deal. Hollister is doing well. The whole sector looks good. So those are the ideas that I have. If you like those ideas, hit that like button. If you want a free course on how to find the next NVIDIA without gambling on startups, hit that subscribe. I'll post that in the YouTube posts once a month for subscribers. And if you want to head over to the Discord at 9:30, where I'll be, hit that first link in the description, stockscommunity.com. 7-day trial for $25. I'll see you in the next one.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.